Good evening, and welcome to this edition of Ironwood Wealth Management's Quarterly Insight Call. My name is Sean Rogers, and as always, I will be your host for this evening. I'm one of the portfolio managers here at Ironwood. Get some housekeeping out of the way first. Got some disclosures to go through. I say this at the beginning of each of these talks, but if you could please leave your questions, or I'll get to the questions at the end, but you can go ahead and type them into your question box, which is located on your GoToMeeting dashboard. At the bottom, there's a questions section. You can open that up and go ahead and type in a question, and I'll get to those at the end. So let's go ahead and get started. So the topics that we're going to cover this evening, we're going to go over what exactly happened in the second quarter of 2012. And more importantly, we're going to try and shed some light on what's going to happen the second half of 2012. There's quite a bit of uncertainty, and we're going to try and shed some light on that throughout this presentation. And then finally get to the investment implications and what we believe is going to happen in the second half, how that affects our portfolios. So we'll jump right into this. The second quarter, equities muddled through the second quarter of 2012. The S&P 500 was down 2.8%. The Russell 2000, which is small cap, lost 3.5%. So those are two domestic indexes. If we look internationally did even worse. Emerging markets lost 8.8% and developed international lost 6.9%. On the other hand, the 10-year Treasury rate decreased from 2.23% down to 1.67% and has since even gone past 1.5%. But during the second quarter, we saw a decrease of 56 basis points on the 10-year Treasury, which is very significant, and I'll get to that a little later. ISM numbers have come in much more weak than they had at the beginning of the year. However, they are right around the 50 mark, which implies we're not contracting, but we're also not expanding. So we're kind of in a wait-and-see mode, and that's kind of the theme of tonight's discussion, which I'll get to here in a little while. U.S. job market also slowed during the second quarter. During the first quarter, and these numbers are a little bit outdated. We've had some revisions, but during the first quarter, we actually averaged 225,000 new jobs created each month. Over the first 3 months of this year versus the second 3 months of this year, we only added 75,000. That's barely enough to keep unemployment at its current level. So we'll get into those things a little bit more. Here are the returns for the second quarter. We can see the best performing asset allocation is real estate. It's pretty much been much of the same. I'm going to talk a little bit more about real estate and dividends and interest and the environment that we're in and why maybe real estate has done so well over the past 2.5, 3 years. The second best performing area was the bonds, and a majority of that was from that 56 basis point drop in the 10-year Treasury, which is very good for bond returns. Although long-term, it's not good for the interest of the bonds. You can see an asset allocation that is made up of these various weights down here, lost 2.1%. So basically, if we were to sum up the quarter, aggressive assets, for the most part, did poorly to moderate. Safer assets did okay to even. And that's pretty much where we ended up. International did much worse than domestic. a lot of that due to the headlines that have come out of Europe, and we'll talk a little bit about that as well. So a big theme of today's discussion is this wait-and-see mode, and the U.S. economy is definitely in this wait-and-see mode. I talked about some of these things, but jobs, the U.S. economy only created 75,000 new jobs per month in the second quarter. Now, tomorrow we get another jobs report, so we'll be looking at that tomorrow morning. But 75,000 is not robust numbers, but it's definitely better than what we saw in late 2008. At least we are creating jobs right now, and the unemployment rate can stay around 8.2% instead of going up. Initial jobless claims, which should give us an idea of future unemployment and jobs created, have actually looked fairly well over the past couple of weeks. They spiked up early in the quarter, but the past couple of quarters, you can see July 7th, we had a print of 350,000 jobless claims, which is the lowest number that we've seen in 4 years. Since then, the 350,000 followed. The following week, we had 388, followed by 357 and 365. The important thing is that these weekly numbers can be pretty volatile, but what we look at is the 4-week average, and that 4-week average keeps coming down, so that's a very good sign. The ISM non-manufacturing number was at 52.1 for June, which is above 50, and service sector is very important for the U.S. economy. 52.1 is not a overly robust number, but anything over 50 does mean that we are expanding, even though it's very slightly. ISM manufacturing was at 49.7 for June, and just slightly higher than that for July. So just under 50, which means we are contracting, but we're really close to 50. So that follows my wait-and-see theme here. You know, we're not expanding, but we're not contracting either. And we've got some really big headwinds that we're facing and a lot of uncertainty. And so it makes sense that a lot of these indicators are in this wait-and-see mode. GDP came in at 2% for the first quarter, and 1.5% was the first estimate for the second quarter. Quarter 4 for 2011 was revised up pretty substantially from 3% to 4.1%. So if we go back to the fourth quarter, you'll remember, and if you don't, I'll remind you that the S&P 500 was at about 1075, and we had a GDP growth rate during that quarter of 4.1%. So just because the stock market is down, you know, in a particular quarter doesn't mean that GDP and productivity and production isn't growing robustly. There could be other things. Back then, we had a lot of euro headline risk, and once the ECB came out with the LTRO program, it kind of calmed down some of the international markets, and that's when we saw stock markets across the world start to improve. But I just point this out because back in October, we had a bottom in the S&P of 1075, even though in that fourth quarter we grew at 4.1%. So the stock market is definitely a fickle beast, and we want to make sure that we have the right time frame in order to be in the equity markets, either here domestically, internationally, in any of the aggressive assets. We need to make sure that we have the right time frame because these numbers are changing all the time, and the stock market is interpreting these numbers and trying to adjust constantly. The cyclical sectors are in the U.S. at least, are showing improvement and are getting back to long-term averages. If we look at light vehicle sales. In May, we were at 13.7 million units. In June, if we were to update this slide, in June we were at 14.1 million units, and July's numbers just came out recently. We were at 14.4 million units. So we are getting back up to the average on some of these very big cyclical sectors that are very important to the U.S. economy. Inventories are tight as a drum. You can see that these are days of inventory, and we're at very low levels. So if demand picks up, companies are going to have to produce stuff so that these inventories don't dwindle even further. So that's a very positive sign as well. Another positive sign is the real estate market. We've heard a lot of positive news about the real estate market lately. Prices have started to come up in certain areas. Inventories are going down. I mean, it's still very spotty data, but in general, the trend is upward for housing, which is very good. It'll be less of a detraction, maybe even a positive for GDP growth in the future, and that's all we can ask for. And we're still way below the average that housing should be at based on population growth. You know, we're looking at probably around 1.1 million or 1.1 million units needing to be added to for housing starts just to keep up with the population growth. Real capital goods are at 15-year averages. They've done very well. Companies are ordering. Companies are doing very well, and they could be ordering even more. But once again, they're in this wait-and-see mode because there's a lot of uncertainty. So compared to 3 years ago, these metrics have improved tremendously. However, we're still far off from being overheated in these areas, and we believe that when some of this uncertainty is removed, that some of these cyclical areas can really help the U.S. economy and the world economy in the future. There's definitely been a slowdown from the fourth quarter, and even fourth quarter 2011, and even the first quarter of 2012. Like I said, the revised numbers for quarter two were 2%, excuse me, and the first estimate for the second quarter is at 1.5%. But that is a far cry away from the 0.4% that we saw middle of last year. So the recession fears are much lower right now than they were last year at this time. So even though 1.5% is, is not a very great number, it's not a horrible number either. We'd love to see it closer to 3, but 1.5% doesn't put recession fears back on the table. It's just slow. It's that wait-and-see mentality. We believe this wait-and-see mentality is for two major reasons. The first is the fiscal cliff. The second is the European sovereign debt crisis. However, we are very, like I said before, just because these two major reasons, these two headwinds that are very uncertain, and companies and investors don't really know what's going to happen, the reason the markets are holding up is because this 0.4% GDP growth we're not close to that. We're still growing at 1.5%, even with a lot of this uncertainty. So I'm going to dive into these two major reasons a little bit further. I think this chart here on the right shows the fiscal cliff scenario and why we're in the situation that we're in the best out of any of the slides that I've seen. Long run average is that the government spends around 20.5% of GDP, and we get around 18% in revenues from taxes. You can see we are, since the recession started, we actually were within range. when the recession started. But shortly thereafter, because of the stimulus and because of some of these spending programs, we've jumped up from right around 20% spending all the way to, we were above around 25, and now we're at 23.4%. And then on the flip side of that, the economy slowed, and so revenues taken in by the government via taxes on income also were hurt. You can see that we were above 18% here, and now we're at 15.7. So this gap, this deficit gap, has widened, and that is a very big problem for us, mostly caused by the recession in 2008, 2009. So what's this fiscal cliff that everybody's talking about? Well, it's because of this, we need to reduce this spending number, and we need to increase this revenue number for the government in order to get back in line so that our debt to GDP doesn't get way out of whack. With the law that we have in today, or the law that's in force today, there is a huge cliff that we're all facing. I'm going to talk about these first three, the biggest three. January 1st, 2013, the Bush tax cuts are set to expire in today's law, which is $221 billion, roughly, of a increase in taxes. So this revenue number is going to jump up if that happens. Last year, when we were going through the debt ceiling, when the Senate and the House were talking about raising the debt ceiling, they made a compromise, and they said, okay, well, we're going to cut defense spending and non-discretionary spending by $1.2 billion over 10 years. In 2013, we're scheduled to cut about $105 billion of spending. So we go back to here, this number they want to come down. Then the payroll tax, right now we have a payroll tax relief where you're not paying all of your payroll taxes, and that's set to expire with current law as well. So if we add, and then there's some smaller things as well, but if we add all of these things up, the possible change in deficit is $606 billion. Well, that's great if it happens over a longer period of time. It's a fiscal cliff if it happens over 1 year. That could equate to, depending on the numbers you use, that could equate to 3 to 5% negative GDP if all of this were to happen all at once. That most likely would cause the United States to go into a recession. The consensus, at least, is that that would cause a recession in the United States. Here's another way to look at it. Here is the federal budget surplus deficit as a percent of GDP, and really what we're looking at is in 2012 we're estimated the CBO baseline is the current law right now, what's current law. Then the alternative scenario here is, it's written down here. See here. So the alternative scenario is based on the CBO alternative scenario for spending and President Obama's budget for revenues. So they're using some combination of that. So we've got two scenarios here. We've got, okay, this is where we are today, and we can either have the deficit drop to this orange line, which is negative. We're going from negative 7.6% deficit as a percent of GDP on an annual basis to negative 6.6, so a 1% decrease as a percent of GDP, or this other scenario, which is the baseline, which we, are cutting almost 4%. So it's 1% to this orange line, or it's almost 4% down to this gray line. This is the fiscal cliff right here. If the law goes into effect as it's stated today, we fall down to here, and that's a huge drag on GDP, and that's going to not only in real dollars that taxpayers will have to pay to the government, and that the government won't be paying in spending. That's a very big drag on the economy, but it's also going to be a very psychological hurdle for investors and for workers and for CEOs. They're going to be prepared for a very slow year, and then we may be putting one of these back into play, which is, okay, everybody stops what they're doing because they're worried about demand, they're worried about psychology, they're worried about spending, and then everybody stops doing anything, and we get this lost output because no one's doing anything. That's not what we want. We don't want another recession. So realistically, we've got to come somewhere in between this orange and this gray down here. To take it a step further, we can look at this alternative scenario over the next 10 years and the baseline scenario for the next 10 years. We can say, okay, well, what does that do to the federal debt as the total federal debt? Not just this is just annual over here. This is cumulative. So if we're at the orange scenario, which is the alternative, which is using the CBO for spending and then the President Obama's budget for revenues, in 2022, we're going to basically be flatlined a little bit higher than where we are now. That's probably not where we want to be. That's a pretty high level. It's lower than 90%, 100%, where some research has shown that that's the level at which the U.S. Treasury's yields would start to increase, and that folks around the world would stop buying Treasuries, and that would hold that would put pressure on our rates, which would drive our borrowing costs up, and that's pretty much what has happened to some of these European countries. Their federal debt as a percentage of their GDP got over 90%, got over 100%, and that's when the bond markets drove up their cost to borrow, and then that's when all these problems started. So realistically, it's got to be somewhere in between here. We definitely don't want to keep running at 7.6% deficit as a percentage of GDP every year. Hopefully we can get GDP to start growing a little bit faster, which helps, and hopefully we can be somewhere in between these two, so we're not all the way down here and we don't cause ourselves a recession, which would just make this whole chart even worse than it is because our GDP wouldn't grow. So it's somewhere in between there. But this is what everyone is worried about when they're talking about the fiscal cliff. This is going to end up a few different scenarios. One, Congress now can punt to the Congress who is going to be elected in November. And they can say, you know what, we don't want to deal with this stuff, but we're going to extend the Bush tax cuts till 2013 so that the new Congress can figure out the tax reform, the spending reform, so we can figure out what a long-term plan is going to look like. That's probably one of the higher likelihood scenarios. Another scenario is that the current Congress comes to some grand bargain. It's probably very unlikely that that happens with the presidential election upcoming. Those are some of the scenarios. Another scenario is that they don't do anything and we fall off the fiscal cliff. I think that's a very unlikely scenario as well, based on most of what we're reading and hearing from Congress and from the Senate and even from the President. They don't want that to happen. So that is definitely something that we've been keeping an eye on. And when you hear folks talking about this fiscal cliff, this is what they're talking about. The other headwind and the other major concern that we have has to do with the international markets. And if you read the newspaper, or you turn on any of the media stations, you'll be hard-pressed to not hear something about Europe. Here is the second quarter. You can see returns for each of these areas. Let's just go through a couple of them. We have the United States was down 2.8%. We have the EFA index, which is Europe, Australia, Asia, and the Far East, which was down 6.9% as a basket of countries. Europe ex-UK is down 8%, almost 9%. Pacific, not including Japan, is down 5%. Emerging markets are down 8.8% for the quarter. So international, you can see international, some of these countries were really punished during the second quarter. A majority of this, or a big portion I should say, had to do with the currency and the dollar strength over the quarter compared to some of these other indices, which made the U.S. dollar return much worse. So the reason for this, or I should say, some of the things that have gone in play here are the headlines that are happening in Europe. We hear, oh, the ECB is saying one thing, and the markets go up or they go down, depending on what these central bankers are talking about. And it really has to do with this picture right here. I'm going to get to this in a second, but I wanted to first talk about some of the stabilizing factors that have gone on that have helped some of the international markets, one of which is back in December, the ECB decided to be very Fed-like. You can see here, this is late 2008, the Fed increased its balance sheet in a very dramatic way in a very short period of time. They were acting as a backstop to the banks in the United States. We had the market bottom in early 2009 after they did this, and we've had a huge run-up since then because stability has been brought back into the market. So ECB did very similar things in 2008, but if you look in just recently in December of 2011, look at the increase in their balance sheet. That's an enormous amount. That's very, very similar to what the Fed did in late 2008. This was LTRO 1, the first LTRO in December. Markets internationally reacted very positively to that first LTRO, long-term refinancing operation, where banks could get 3-year loans basically from the ECB. Just recently, last week, Mario Draghi was very vocal about the ECB doing whatever is necessary to keep the euro alive. Markets took that as a very positive thing. In 3 days, we were up about 4.5%, 4.5%, 450 points on the Dow, 500 points on the Dow in 3 days. That tells you that that tells you that investors at least believe that if the ECB is committed to the euro, that's a very positive thing, and that's pretty much what they're talking about when they're talking about quantitative easing. They're talking about increasing the balance sheet of each of these banks: the Fed, the ECB, the Bank of Japan. However, until Europe forms a fiscal union, they're going to continue to have these problems because they don't have a unified government. They don't have a, somebody in Greece can retire at age 45, whereas somebody in Germany might not be able to retire until age 60. The rules aren't the same for all the countries, whereas in the United States, everyone, let's just use Social Security as an example, everyone's got to play by the same rules no matter what state you're in. That's not the same in the EU. And so we believe that in order for the euro to survive, there's going to have to be a fiscal union, and we've heard a lot of rhetoric in that, or at least in that direction of a unified euro zone and creating some sort of union. But you can see here, I think this chart right here really shows what has happened in Europe over the past couple of years. You can see that before the euro was introduced, Italy, Spain, Ireland, Portugal, France, Germany, they all had different lending rates of their corresponding sovereign bonds. And as we got closer and closer to the introduction of the euro, all of those yields became the same. And they stayed the same for about 10 years. Then the debt crisis in 2008, 2009 happened, and you started to see some deviations. And the bond markets are telling us there's something wrong with the euro right now. And now we're getting back to where we were before. So the bond market is saying, okay, well, we're not so sure about the euro right now. And that's why you see these separations here. LTRO came out at the very end of 2011, and you can see a lot of these rates dropped significantly when that was announced. That's a step in the right direction, but this is creating a lot of uncertainty in the Eurozone. And so we're not going to know what's going to happen, and until we do, it's going to create a headwind on markets, on equity markets around the world. So, you know, I've gone over these two concerns. You might be asking yourself, well, geez, Sean, you know, where's the good news? The good news is that we have seen a lot of blood on the street, especially in the developed markets. So this chart here shows us valuation metrics. We have a composite of these valuation metrics. So forward PE, price to book, price to cash flow, and dividend yield. Those are all metrics that we look at to see if an equity is cheap or if it's expensive. When it's below the average, it's cheap relative to the world. When it's above, it's expensive relative to the world, or relative to its own history. So if we're looking at the All Country World Index, which is U.S., which is international, emerging markets, it's one standard deviation away from its average, which means if you take all of these metrics, we're significantly undervalued from where we are historically. That's all this is telling us. But if we start to look at these, we look at developed international. Wow, we're more than a standard deviation away from its historic norm. France, we're more than one standard deviation. Australia, you know, we're almost 2 standard deviations. Japan, we're almost 2 standard deviations away. Canada, almost 2. You know, I like to look at these baskets a little bit better because we get more diversification out of these, as opposed to, you know, trying to figure out which country is the best at the time. But if we look at this developed international index, yes, it's done poorly relative to some other asset classes over the short run, which makes the price less expensive for us to buy if we were to buy this basket of equities. And when we're investors, we want to try and buy when there is blood on the street, because that means there's opportunity. Right now, EFA index is 2.28 standard deviations away from the relative to the world. The PE multiple is at 10.5 when the average is 13. The price to book is 1.3 when the 10-year average is 1.7. Price to cash flow is at 5 when the average is 6.3. And your dividend yield is 3.9%. So if we were just looking at the dividend yield, we'd look at this index and say, hey, you know, that might be a decent index to buy. I'm buying at a fairly inexpensive relative to history. I'm getting an almost 4% dividend yield on a diversified basket of international developed countries. This may be an opportunity here. Now, if you have a one-year investment horizon, it's not going to be an opportunity because we have too much headline risk. The price of this index can move too much over a one-year period of time. Yeah, there's opportunity there, but it's going to take a long time for us to realistically expect to capture that opportunity. Now, it might happen in a year, but it could go down further in a year as well. So we need to make sure that we have the right time frame for some of these investments as well. But if we look at it bigger picture, these are very attractive places to buy. Staying with this dividend theme, we can see that around the world, equities and real estate are much more attractive when we're looking at income as opposed to 10-year government bonds in each of these countries. So this is just showing us, in the U.S., the current 10-year Treasury is at about 1.5 as of today. The U.S. REIT index is yielding 3.6%. So that, you know, if we're just looking at yield, that might be more of an attractive place to be. Realize that with REITs comes more volatility. So we need to make sure we have the right time frame. With Treasuries, there's not as much of that volatility as a REIT, but there still could be some volatility depending on what interest rates do. But I just wanted to point this out because they're, you know, in Singapore, where our REITs in Singapore are giving us 6, where the bond yields are about the same as the U.S. 5.9 for France. You can see that government bonds are much lower than equities or REITs during this period of time. The other thing that I wanted to point out is since 1926, almost half of our return has come from dividends. So they're important, but capital appreciation is also important. We want to make sure that, you know, I hear a lot of folks in some of the media focusing on high yield and dividends this and dividends that. Because of that, REITs have done very well. Utilities have done very well. It may be time to look at some other areas than what has been performing well over the last year. Some of those areas have been run up because people have flocked to them because everybody's talking about it. But there is also this capital appreciation, which we haven't seen too much of over the past 10 years, or in the 2000s, we actually saw negative capital appreciation. So we want to make sure that we're focused on both of those. Cash accounts are paying us next to nothing right now. You know, 0.4% in 2009 for a $100,000 CD investment would have earned you an annualized rate of 0.4%, basically. You can see that cash as a percentage of total household financial assets increases as the stock market gets crazy. So March 2009, we had a S&P low, and you can see our cash position is almost at the highest level possible. So what were people doing? They were selling assets that were doing poorly. That's exactly the opposite of what we really want to be doing. We want to be buying during this time. This is akin to the international markets that I was saying earlier. Yeah, they're volatile, but there's also a lot of blood on the street. There's some opportunity there as well. But all in all, there's still a lot of cash on the sidelines that needs to be allocated somewhere. Pension funds, investors, they're not going to get the job done by sitting in cash earning next to nothing when inflation rates are higher than what they're earning in cash. I'm going to get to bonds in a second, but the same is true for bonds. At some point, this cash is going to need to be invested. That's why we believe that most people that have wanted to sell and get out of the equity market have done so. There could well be a floor on the equity market because a lot of the folks that were wanting to sell have sold, and not a lot of folks have gotten back in yet. So that could be a backstop, if you want to call it that, in the equity markets. Now we're going to get to bonds, and I think this chart down here says it all. You can see that in the past 6 years, there have been $1.2 trillion into bond funds versus $205 billion into stock funds. Now, that is $1 trillion more into bonds versus stocks. And it's very easy to see why this has happened. Very easy. Just to give you an idea of the magnitude of this $1.2 trillion into bond funds, back in the 90s when we had the stock bubble, there wasn't even this much flows into equities that there has been in bonds over the last 6 years. So that should give you some perspective on how much money has actually gone into bonds. And it's really easy to see why. The reason why is, well, I'll get to the reason why here in a second. But first, I wanted to bring up some more valuation metrics here. This is just focusing on the valuation measures for the S&P. So these are domestic measures. I think the most important slide is this one over here, where we see that the earnings yield, or the reverse of the price earnings multiple. So if we were to look at the S&P 500 more like a bond versus a stock, it's yielding us, or the earnings yield is 8.1% right now. That's a significant number, and even more significant than that is the gap between the earnings yield of the S&P and Moody's investment grade yield at 5.1%, or just below investment grade yield at 5.1%. You can see that we had a huge gap in the late 90s where stocks were not giving us a very good earnings yield, and bonds were giving us a great earnings yield. Well, this was the time to be buying bonds, not stock. Now we've totally reversed that. It's time to be buying stock versus bonds. Now, that doesn't mean that we want to load up somebody who's in retirement with 100% equities, because that will go against their time frame, because they do need some money for income and retirement, and we want to make sure they have a diversified portfolio. We just see more opportunity in equities than we do bonds on a risk-adjusted basis. Just another metric here, price earning, lagged price earnings. As of June 30th, we're at 12.1. The average during recessions has been 12.6. So we're not even at a recession. People aren't even willing to pay up for stocks like they would during a recession, let alone during an expansion. So we believe that there's a lot of room to run for stocks. This chart is one of my favorites. This last webinar we had, this is a 10-year annualized return. Now we've actually changed this to 5-year. This is just saying that, okay, seeing you're talking about these price to earnings multiples. You say things are cheap in the equity markets, so that means I should go out and buy these things. Well, this chart is showing us that over a 1-year period of time, price to earnings multiples that are cheap or low or attractive will not equate to a positive return over the short run. So over 1-year periods, if we look at every time we had a PE multiple, or this is PE multiple and then the corresponding return, you can see that there's no real regression line here. Doesn't matter where PEs are. They could be at, PEs could be at 25, and we could still get 35% return. You know, this might be the end of a bubble market in the equity market. You can't tell on a one-year basis what the return is going to be based on what the PE is. But if we extend that to 5-year annualized periods, now we're starting to get a regression line, and we're actually starting to see some meaningful data. If we look at 12.1 PE, and we look at this line right here, this is probably equivalent to, let's say, 15% annualized returns or thereabout. If we were to draw a line here and say, okay, well, I'll bet there's 75%, 70% of the time that we have PEs at 12.1, the next 5 years we average 15% or above. That's pretty dang good. And the worst that we've done is this one here, which is probably high single digits with a PE that much. So I just ran some numbers. Just said, okay, well, what if we get this 15% per year for the next 5 years? Well, I think everybody would be pretty happy because the S&P 500 on July 1st, 2017, if that were to happen, if we were to have a total return of about 15% annualized for the next 5 years, the S&P 500 would be at 2,400 by July 1st, 2017. I think most folks would be very happy with that. I know I would. But you know, this, once again, this is looking at history. History doesn't always repeat itself, but if you bought when PE ratios are at 12.1% and you've had the right time frame, you've for the most part gotten paid off pretty well in order to buy into a market that doesn't look great. You know, how many people want to rush out and go buy anything in Europe right now? Not too many people, not with all the headline risk. But over long periods of time, if we look back at this period 5 years from now, we may be scratching our heads saying, man, I wish I would have purchased some international stuff back when PE ratios were so low on a historic basis. That goes for domestic as well. This chart right here is getting back to my, you know, I alluded to it here with all these bond purchases or flows. This is the reason why. We've had a huge bond bull market for the past 30 years. You can see that since September 30th, 1981, we had a 10-year Treasury rate of 15.84%. Right now, we're at 1.5%. If this were to be updated, we're at 1.5%. That's a decrease in interest rates by 14%. Decreases in interest rates are very good for bond funds, for bond, for the principal amount of your bond value goes up. Your capital appreciation on your bond goes up. It's not good for reinvestment interest rates. You know, if we go out and buy a 10-year bond today, we're only going to get 1.5% per year. The other thing I wanted to point out on this chart is this is the zero line. There have only been a very few periods of time in the last 50 or 60 years where we have had negative yields. We have negative yields right now. Just to give you an idea of what that means, it means that some investors are willing to forego purchases today only to purchase something smaller later. For example, some folks right now who are purchasing 10-year treasuries are giving up, foregoing buying, let's say, 100 gallons of milk today in order to, in 10 years, buy 95 gallons of milk. That's a very strange period of time, and we believe that a big factor in this has to do with fear, and that folks are so fearful that they're willing to forego buying 100 whatever and put that money into a 10-year treasury. 10 years later, their purchasing power is going to be less because they bought that treasury and didn't have any inflation protection. Inflation was higher than the yield that they're getting from treasuries. So that's a very unique phenomenon, and you can see over the last 60 or so years, it's only happened a couple of times and not for very long. So that's one thing we want to keep an eye out on. Just to take this a step further, you know, we really want to be careful of the bond holdings that we have. There are folks out there who have looked at the past 10 years, and because of this phenomenon, their bonds have done very well. And, you know, they may have a 100% bond portfolio, and they may have 100% safe bonds, treasuries long term. You know, just to give you an example here, let's stick on this 10-year treasury since that's the yield that I've been talking about throughout the presentation. If the 10-year treasury was to go from 1.5 to 2.5, and you bought a 10-year treasury while it was at 1.5, let's say you put $100,000 into a 10-year treasury. If that rate were to go up to 2.5, which wouldn't be out of the ordinary, 2.5 is still a very low rate, your $100,000 investment would be worth $91,000, and you would have earned $1,500 for the year in interest. So a safe, or what is deemed to be a safe bond, a U.S. Treasury, if interest rates were to go up, you could lose 9%, you know, after your 1.5% of income, you're looking at down 7.5% in a treasury, a safe investment, or quotation safe investment. If we're looking at 30-year treasury, it's even worse. You know, you're losing almost 20% if interest rates go up by 1%. So we really want to make sure that the bond portfolio that we have, one, has a yield advantage. So instead of earning 1.5%, we're earning 3 or 4 or 5 or even maybe 6, depending on our risk profile. And we may want to focus on some of these bonds that have less duration risk, or interest rate risk, I should say, less duration, which means less interest rate risk, so that if interest rates do go up, your bond isn't going to get hit as hard. So, you know, that's really the caution that I have. You know, if we were doing these webinars back in '99, we'd probably be talking about PE ratios being way too high, and that people have to be careful about these stocks that have produced 100% rates of return, and everyone's getting lured into because they're earning 100%. Well, that can't happen forever. And shortly thereafter, we had a bubble and it burst, and stock performance was very poor for a few years. Well, we want to make sure that investors and colleagues and friends are making sure that we don't have this problem, that people aren't getting lured into this, quote, safe investment, and they're not quite looking at all the risks that are involved. S&P 500 return needed to reach 2007 peak. Well, we've been talking about this for quite a while now. We see that our March 9th, 2009 trough, 677. Man, I'm glad we're far away from that. We're at 1362, or we were at the end of June. We can see that the longest it's ever taken was back at 73, 74, where it took 5.8 years. We're coming up on 4 years. You know, next March, it'll be 4 years since the trough of the market. So we're getting close to that, which was the longest time that we've ever taken to recover. So let's just say that it takes us another 2 years, 3 years to get back to our old highs. Well, let's look at these between 2 and 3 years. We're looking at, okay, 0.7% return from our equities, total return from equities. That's not horrible. And if it's closer to 2 years, 9.2%. And if it happens, very quickly in 1 year, it could be 17%. It's probably somewhere between now and 3 years from now, based on our research. But once again, no one knows what the future holds, and so we want to make sure that we stay true to our diversification. This slide is just showing that more diversification compared, these two portfolios are very similar. One just has a lot more diversification than the other. You can see that if we look at the standard deviation of this portfolio, it's at 10.94% versus 9.97%. So we get a less risky portfolio, or less volatile, I should say, portfolio when we have more asset classes added to it. We actually get a higher return. So we want to make sure that we're diversified. And then the other thing we want to do is make sure we have the correct time frame for our investments so that we don't have to be the average investor. The average investor is in and out of the market in just over 2 years. And because of the timing and the emotional decision-making process, you can see that the study done by Dalbar, the average investor over this 20-year period of time has earned 2.1% annualized, under inflation. So the average investor has lost purchasing power over the last 20 years. When if they would have just bought, gold, or they just would have bought the S&P 500, or a combination of these asset classes, and just had the right time frame, they would have done a lot better. This is just another slide that shows that. Over 1 year, the equity markets, this is just showing the S&P 500. The best return over this period of time, 1950 to the end of 2011, the best return has been 51% over a 1 year period for the S&P 500. The worst return has been negative 37. If you have something that you're investing toward and it needs to, you need to liquidate the investment in 1 year, we're not going to tell you to be in the stock market. We're not even going to tell you to be in the bond market, because you're putting a loss on the table. If you don't have 5 years or longer, we really want to look at short-term cash equivalents, and maybe some short-term bonds if you've got to use the money within a 5-year period of time. If it's longer than a 5-year period of time, well, now if we look at stocks, the worst 5-year period of time annualized has been negative 2% per year for stocks. The best has been positive 28. Okay, now we're getting a little bit more risk-reward benefit from owning some equities. Bonds, 23 and negative 2. If we have a 50-50 portfolio, there has not been a 5-year period of time when we have lost money in a 50-50 portfolio. That should say a lot about time frames. If we had a 50-50 portfolio and we had 5 years, we would have made money over these periods of time in this 50-50 portfolio as long as we didn't touch the money. Our worst case scenario was up 1% per year. Our best case scenario is up 21%. And as you move further down, as you give your investments longer time, you end up improving this risk-return relationship. Retirees who come to see us when they're retiring, it's not the end of their portfolio. We need to make those retirees' portfolios last sometimes 30 and 40 years, depending on when they're retiring. With that type of time frame, we definitely want some equity exposure, because we get, we're getting better rates of return on average over long periods of time. And you can see the growth of $100,000, 10.8 versus 6.3, it doesn't sound like a lot. It's 4.5%. But look at what that growth of $100,000 is. That's a significant amount, and that's because of compounding. You have 100,000 that turns into 337,000, or 100,000 that turns into 771. As long as we have the right time frame, we can build a portfolio that might not be 50-50, but it's going to be customized to each individual investor to hit their particular goal based on their resources, based on their cash flow needs. And so that's really what we do here at Ironwood, is build customized portfolios for folks so that they can get the most out of their portfolio. Investment implications, overweight, this hasn't changed much because the environment that we're in really hasn't changed that much. There's still a lot of blood on the street. And maybe I should take a step back a little bit. We're getting a lot of folks saying that this year has been a kind of a bad year, but look, the equity markets through the first half of the year were up over 12% on the S&P 500. Year to date, we're up about 10%. We're only halfway through the year. That's an annualized rate of return of almost 20%. So this year hasn't been awful. We've had a good year. It's just been very volatile, and some of the longer term plays that we have are still there. We're still overweight commodities. Commodities have been one of those things that have had blood on the street. Lots of the commodities have been hit pretty hard more recently, but the Fed is still easing. ECB looks like it's still going to be easing, which could be a tailwind for some of these commodities. International equities, valuations look very attractive. Dividends are high. I like to get paid to wait for our prices to improve. I'd rather wait in something that's paying me 4% than something that's paying me 1.5%, even if I have to take a little bit more risk to do that. Floating rate bonds, we're under. Our perception is that when the economy starts to recover, interest rates are going to start to go up very fast. Investors can leave the bond markets and go after some of these higher returns if they start to see them in the markets. You can only have pension assets sitting in something that's earning 1.5% for so long before you have to take some risk to give the pension beneficiaries the income that you promised them. So there could be a lot of tailwinds for the stock market, and we believe that some of that might be very bad for bonds as interest rates start to increase. So we're proponents of floating rate bonds, which change their interest rate every 90 days or so. Market neutral, another way to kind of keep the portfolio at a lower risk, but not take as much interest rate risk, or take most of the interest rate risk off the table altogether. Things that were underweight, long duration fixed income were underweight, treasuries were underweight. Gold has had a fabulous run. We'd be hesitant to add gold to any of the portfolios. We see gold as more of an insurance play. And then cash. Now is a good time in our estimation to get some unused cash deployed. Do you want it sitting there in cash, or do you want it sitting there in, as long as we have the right investment time horizon? If we're retiring now, or we just started retirement, or we're 10 years from retirement, or as long as we have 10 years, 20 years investment horizon, which most everyone we meet with does, we can take some of this cash and put it into international equities, earn 4%, and wait it out until those valuations look less attractive, which means prices went up, and which means we've had a decent return. So something a little new on this last slide. I always talk about this cumulative return, And I always say, okay, well, you know, a lot of people have been talking about this dead decade that we've had. Well, this asset allocation portfolio has been up 86.3%, which equates to 6.4% a year. And you can see, you know, emerging markets have done very well over this 10-year period of time. REITs have done very well over this 10-year period of time. Bonds have done very well, especially on a risk-adjusted basis. The S&P has done poor. But right now, if you were to look at the short run, the last year, year and a half, 2 years, and you looked at your portfolio and you said, gosh, why do I have so much international in my portfolio? I wanted the S&P 500 in my portfolio the last couple of years because it's done relatively a lot better than some of the international markets, up 26, up 15, up 2 last year. But if we look at that compared to international, you know, international is up, international is down 18% last year. Emerging markets were down 18% last year versus the S&P was up 2. So, you know, over the short run, man, we wish we were domestic investors. But long run, over the past 10 years, it would have been nice to have some international and especially some of this emerging markets. You can see by this chart, the different colors are all over the place. What we want to do is we want to make sure that we have a diversified asset allocation so that we know we can get a decent return over any type of market. We don't want all of our eggs in one basket either way. Now, if we were looking at short term, you'd love to have everything in the S&P 500 over the past year and a half because you would have missed out on you know, this negative 8.8 so far or in the second quarter of 2012. You would have missed out on 18% down in emerging markets. But that's looking at it, you know, very short term. We're not looking at it as short term. We want to look at it over longer periods of time when, you know, some of these international markets, if we would have had them in the portfolio, are going to boost our total return versus just owning domestic. So that's why those international funds are in the portfolios. And you might be asking yourself, well, man, with all this headline risk in Europe, why am I owning these things? It's because, 1, the dividend is good, and 2, long run, it's going to bring down our risk as a portfolio, and it's hopefully going to increase our potential for maximum return. So with that, I'll take some questions. Let me just open my little question box here. We've got some questions, so I'm going to go ahead and see here. How do I make this bigger? Here we go. So the first question is, do you think the result of the upcoming presidential election will impact the wait-and-see mindset of the domestic economy? I definitely believe that the presidential elections being behind us, I don't even think it matters who wins. I think just knowing the outcome is going to take a lot of uncertainty off the table. Along with, after that happens, we'll get the lame duck Congress and Senate to either pass an extension of the Bush tax cuts or come up with some kind of compromise, or they'll do nothing. But either way, we're going to know shortly after those elections what they're going to do, and the market is going to react. I think, or we believe, and most of the stuff that we've looked at is saying that we're going to get an extension of the Bush tax cuts, most likely, which I believe will be a tailwind to the domestic markets. So yes, that would get rid of some of the fiscal cliff scenario once we get through the election. Next question is, what would be the big picture consequences if Eurozone countries were to abandon the common currency? there definitely would be some adjustment in those countries as far as GDP growth. Those countries that are weaker, that if they go to their own currency, they're going to inflate their way out of debt. And that's going to have a dramatic impact on the citizens of those countries, and it's probably going to derail those economies for a few years. With that said, I believe the bigger economies, Germany, France, and some of the bigger ones in the Eurozone are very committed, based on the statements made by some of the policymakers out there, are very committed on keeping the euro. So the breakup of the euro would have a detrimental impact on world growth, which I think would have a detrimental impact on stocks. Bond rates of sovereigns in weaker countries would increase. Bond rates in stronger countries would decrease. And you'd get a divide, and the markets would create that divide in the bond markets, and it would be very hard, it would be very difficult for some of those economies, and the only way they'd be able to get out of it is to inflate their way out, which would put their economies back a few years. So although I don't think it's likely for the entire euro to be abandoned, if that were to happen, it would definitely have a shakeup, and you can see that in those charts that I was showing. That's exactly why these bond rates have diverged so much over the past. This chart here, that explains it right there. You can see that the stronger countries have decreased their lending, so Germany and France, while the weaker economies, all their borrowing rates have increased dramatically over short periods of time. So these countries would all be impacted negatively, and they'd probably have to inflate their way out. But I don't think that that's the likely scenario. I think the likely scenario is some sort of compromise, kick the can down the road, maybe even a fiscal union for some of the Eurozone countries who want to continue on that path. Looks like that's the last question. As always, if anyone has any questions, please feel free to reach out to your Ironwood representative. We'd be happy to answer any questions. Please feel free to email any of the portfolio managers, and we will talk with you guys next quarter. Take care.